Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got stocks higher with oil prices plummeting again as investors bet that a delicate ceasefire between Israel and Iran will hold. So looking at the session, the Dow Jones Industrial Average climbed 1.2%, closing at 43,089. The S&P 500 was up 1.1%, closing at 6,092. And we've got the Nasdaq Composite advancing 1.4%. The outperformer settling at 19,913. So we've got oil prices down again. Looking at Brent crude, that's down by over 6%. And a day earlier, down more than 7%. Let's check in now with Mark Giambrone. He is the head of U.S. Equities and portfolio manager for Barrow Hanley Global Investors. Mark, thanks for joining us on the show. How are you doing?
Good. Good morning. Thanks for having me.
It must have been quite a busy week for you, Mark. Let's step into what's pretty much on the table here. Front and center is the ceasefire between Israel and Iran. There seems to be added uncertainty in the markets, but we are seeing things in the green to some extent. So what do you take away from the market action right now?
I would start by saying it's been a busy year, and certainly the last week has also been very busy. You're right. I think the market is clearly very pleased with what's happening with the Middle East situation at the moment, at least with Israel and Iran. I think the market is viewing this as not just a ceasefire and not just a short-term stoppage of a 12-day skirmish. I think they're viewing it as the potential for longer-term peace, which has significant upside to, the economic situation in the Middle East, the market's comfort overall with sort of shocks in the system. So I think they're viewing this as a positive outcome, the most positive outcome maybe we could have had in a short period of time. And then I think the market is now also looking at a few other things in the U.S. So as you mentioned, oil prices coming down significantly, good for inflation, good for the consumer. The Fed is now speaking about the second half of the year and the thought that there will be some cuts by the Federal Reserve here. There is a very large tax bill, which we do view as a positive stimulus here in the U.S., working its way through Congress and actually making some meaningful progress in that way. So there are multiple things that are suddenly happening where if you go just a week or two ago, as you suggested, you could have made the opposite argument about maybe every single one of those things. And so I think the market is liking what it's seeing at the moment and getting more optimistic about the back half of the year.
Yeah, optimism in the air. Some might say complacency. Let's unpack a bit what Jerome Powell has been saying. So he was giving a routine testimony in Congress, and he told lawmakers that the central bank can afford to wait for the impact of tariffs before deciding on further interest rate cuts. I have been hearing from some market watchers that they could be looking at a July rate cut at the earliest. So where's your take on how early and how many we are expecting this year?
I think July is unlikely at the moment, is my opinion, based on the, we can wait and see. I don't think we'll have much information around July. And if you remember, July the 9th, it's also the current pause in the increase in tariff rates. And so we'll probably get a lot of information around now through July 9th to see if there's any true negotiations, treaties passed, a push again, that may actually have the Fed react one way or the other. I do believe, however, that tariffs are not inflationary. They haven't been inflationary so far. They may actually be slowing things down. We'll see how unemployment numbers look here in the U.S. over that period of time. And I think in the second half of the year, the Fed is probably more than likely to start cutting. And frankly, once they start cutting, I think they'll probably cut more than the market expects. So I would say at a minimum, we'll see 2, 3 or so cuts once they start cutting. So I want to be clear about that. I'm not certain that that's going to happen in July or in September, but I think September is much more likely than July.
Okay, you talk about the tax bill being good for the economy and the markets. The other part of the equation is how there are concerns about the fiscal deficit. So are those concerns overdone right now?
It remains to be seen. And so to be clear, I'm not trying to dodge the question, but the House bill and the Senate bill are different. Both do add to the deficit, which is discouraging to most people. They're not counting any of the tariff revenue at this point in either of those bills. And if you look at some baseline of tariffs, if they were to stay, there's actually a significant offset to the increase in the debt levels. But the deficits come down pretty meaningfully in the Senate bill versus the House bill. And so let's see what type of compromises we get to. I think the market was initially concerned we weren't getting a debt reduction. I think it is a disappointment that we're not getting a debt reduction, and it's negative for the long term. But we are reducing the deficit at this point in terms of the absolute level, and that is a positive. And getting this bill passed will lead to more economic activity, we believe, which may then offset some of the deficit with growth.
All right, Mark, in line with that, we have also been hearing from some fund managers about how they diversifying or rotating away from the U.S. because of various reasons. One is the so-called de-dollarization narrative, and also how we have been hearing about these concerns about the U.S. deficit. So looking elsewhere for better value, how have you been approaching markets?
I guess I want to take a step back for a minute. I think the U.S. did get to a position in global markets where it was significantly overweight where it had been historically. And in those type of situations, it does make sense to me to look for alternatives on the margin to diversify. I think that's just prudent management. I would also say that I'm hopeful that the U.S. as, sort of a financial place for the dollar, for, debt levels, et cetera, as sort of the world standard, is not going to be impaired enough, even with a deficit within the new tax bill, to have a meaningful change to that. I do understand a concern around that. It should be a concern. But it doesn't appear to me at the moment that there is a better alternative or a reason to move away from the dollar or U.S. assets at the moment. Outside of the fact, I think the U.S. has been on a real big run, especially with, the Mag 7 and some large tech names leading that run. And I think the U.S. simply got overweight in multiple portfolios. And then again, I think it's prudent in those circumstances to diversify.
Yeah, talking about the Mag 7, to some degree, they have been quite insulated. Some folks believe they don't really feel any impact from what's playing out in the Middle East because of the fundamentals. So let's take a look at what's playing out here. And that's where you've got this AI boom. At the same time, some of these big tech names have been making lots of job cuts. What do you take away from the latest market action around the Mag 7?
Well, let's start with sort of the fundamentals in the AI boom. I think that you are correct that the AI boom is real. So again, when we go back to where you want to invest, clearly there are other places that you can invest to find sort of a similar theme. But the largest, group of companies that will benefit from this and are spending the money on it are clearly within the U.S. markets. So I would caution to try to move away from the U.S. markets if you believe the AI boom is real, because you'll get the, call it the biggest bang for your buck here in the U.S. markets. And I don't see that changing over the medium term. I also believe those companies specifically overhired during the COVID period. And I think some of the things we're seeing now in terms of them laying off a small portion of their workforce is really just around rationalization now that people are back to the office, now that we're moving past the COVID period. And there probably was overhiring for the most part during that period. So that part doesn't scare me in terms of the fundamentals. I think the fundamentals, the Mag 7 are different. So they're not one, contiguous group. They are different. But certainly the AI boom is real. Dollars are moving that direction. And it is going to be the next big change in both the economy and the way people work in their life, the efficiencies for businesses. And I think that you can't underestimate the impact that has on the markets and on our everyday life. And it's an excellent place to have capital invested at the moment.
All right, great overview of where things are right now when it comes to AI and what's playing out in the Middle East. We've been in conversation with Mark Giambrone. He is the head of U.S. Equities and portfolio manager for Barrow Hanley Global Investors. Mark, thank you so much for your time and insights this morning. Always a pleasure chatting with you.
Thank you. Same here.
All right.
Have a good rest of the day.
We'll catch up with you again soon, Mark. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.